Okay, so first of all, thank you so much for putting the paper on the program. It's a great pleasure to be here. It's joined with Magnus, Anna, and Julien. In this paper, we rationalize why we see that the dollar appreciates during times of stress, while at the same time, US act as an insurance provider to the rest of the world. So I'll start out with some basic stylized facts. Some of these are well known, others are kind of new to this paper. So I'll start out with asset prices and exchange rates. And the first thing you see here in the red line is the realized volatility of the US stock market. And the blue line is the price of a basket of foreign currencies. So when the blue line drops, that's a dollar appreciation. And what we tend to see is that the dollar appreciates during times of stress here. Now, if you look at stock markets, there's also differential response to that as well. If we measure everything in dollars, we see that the exposure, like they all drop in recessions, not surprisingly, but there seems to be a slightly less drop of the US market relative to the other markets we're plotting here. Now, we want to understand positions and wealth transfer. So I'm going to start out with plotting the assets and the liabilities from the external balance sheet of the US. So on the left-hand side there, you have the assets and you have the liabilities on the other side. And a key thing here is that the difference between these two is called the net foreign assets, and the asset side looks very different than the liability side. The assets are predominantly equity, while the liabilities are predominantly debt. So basically, the US acts as a levered investor investing into stock, and by that, picking up an equity premium. And this is kind of what has been referred to as the exorbitant privilege. They can borrow cheap and then invest into risky assets and earn the premium there. And this has been thoroughly studied, for instance, in Green and Ray in an influential paper there. Now, we want to understand the dynamics of this. And what we see during, we have a time series plot. Again, the red line is just the realized volatility of the US stock market. What we see is that there are drops in the net foreign assets during times of stress. And particularly, if we look at the global recession in 2007, 8, 9, there's quite a substantial drop in the net foreign assets of the US. So this has been then linked to a term called exorbitant duty that were coined by Gorinchas, Ray, and Govila. And really, the idea here is that from this, it's been argued that US is an insurance provider to the rest of the world. And from this, that wealth should flow from the US to the rest of the world during these times of stress. Now we're going to challenge that and argue that, yes, clearly we see that the external balance sheet here, there's a big drop in the net foreign assets. But in fact, there's a flow from the rest of the world to the US in terms of wealth shares here. So how are we going to do it? Well, first, just let's think about wealth. Wealth, you can decompose it in several ways, but one way would be to say it's the wealth of everything produced in the US plus the net foreign assets. So clearly, if most of the wealth is in the domestic assets, well, we can't really conclude just looking at net foreign assets that there will be a wealth transfer to the US or from the US. We need to look at the total welfare. So we're going to take a very simplified approach in the baseline here, and we're going to value the domestic wealth component by just a simple multiple. I'll argue that that's kind of conservative here, but we're going to assume that it has the same valuation ratio as the stock market in the US. Now, if we do that, this is a plot of the wealth share here. You see that, if anything, it seems to be that the wealth share actually increases during, for instance, the global recession here, 2008 and 9. Not a drop as what's been concluded previously. Now, where is this coming from? Well, our approach is basically a top-down. We try to directly go at the GDP, valuing that. And if we think about it kind of simply, what kind of range we would expect these valuation ratios to be, well, the stock market is around 30 to 40. So, you know, if we think it's as risky as dividends, which is unlikely, well, this ratio might be quite a lot higher for actually the wealth ratio here than 30-40. So that's why we think it's quite conservative. Now, in terms of what others have done, they kind of built this from bottom up. You take whatever you can observe, you measure this, and the implied valuation ratios are very low. They will be in the range of 3 to 6. So if we think about really total welfare, the domestic wealth component will be very small if you base it on what you can measure directly. And then the NFA component will be a very important driver of the wealth shares. But once you use realistic valuation ratios, the domestic wealth component becomes much larger. So that's kind of in a nutshell what's going on here. So, you know, also based on this, you can kind of like back of the envelope imply some discount rate if valuations were around 3 to 6 and growth about 2%. That would imply like a discount rate around 18.67% here, if you even use the high 6 number there. So this is, let me, it's jumping a bit. Okay, there. So we have a model that rationalizes these things. And here I'm just going to do a very, very stylized illustration of what's going on, but I'll get more into the details later. What we have is that there's a shock to the US here, the GDP. The US dollar is going to appreciate. The US good is more scarce. Stock markets all over the world are going to fall. Now, the US stock market falls less because of a strong dollar appreciation here. That overturns kind of the local currency returns. And what we have is that, yes, the net foreign assets, they fall because they have a leveraged position, but most of the wealth is still in US dollar denominated assets. And that component is much, much bigger. And therefore, we get a wealth share that increases, not decreases, in times of recession. So this is related to something called the reserve currency paradox that Maggiore pointed out, which is, in times of stress, we do see the dollar appreciate, but it's hard to reconcile that with a wealth share that is falling, a US wealth share that is dropping. This is related to an old problem called the transfer problem. We know that there's typically a consumption home bias. So if there's a wealth transfer from the US to the rest of the world consumers will increase the demand for the local goods more heavily, actually implying a depreciation of the dollar, not an appreciation. Well, in our setting, there is no paradox because, yes, we see net foreign assets fall, we see dollar appreciates, but there's actually a wealth transfer to the US, not from the US here. So what is our model? It's an end country, end good model, so it's kind of a standard international setup. We need time-varying risk premia here. The way we model this is through habits formation. And we have good specific habits. That's important for 2 reasons. One, it gives you kind of time-varying risk aversion, but it also gives you time-varying elasticity of substitution between goods to get excess volatility in exchange rates. There's a consumption home bias, and given these kind of preferences, you're going to see that rich countries actually can afford to behave as being more risk tolerant here. So if US is rich, they're going to behave as a more risk tolerant investor. We get everything in closed form solutions, so it's tractable, this setting. And what we show that is, in times of stress, we see a wealth transfer to the US. We see a net foreign assets that fall. So far we're kind of consistent with Greenwich and Ray and so on, and a dollar appreciation. The big difference is the wealth transfer to the US. Now on top of that, we get a reasonable match to asset pricing and foreign exchange moments. And we can recognize things like the failure of the UIP and more recently kind of the reversal, which like Engel pointed out, it's hard to match in frictionless models. Now why do we think that's important? Well, if you want to talk about wealth transfer and positions in risky assets, you don't want to have an investment opportunity set that looks completely different than what the data implies. So jointly matching prices and quantities here is kind of key to the credibility of the story in some sense. Okay, so I'm going to skip the related literature and go into the model. As I said, N countries. Every country consumes every good in this model, and there's a representative agent in each country that has habit preferences. Now these are good specific, so they have a habit for each good here. It's going to be a complete market frictionless economy, so we can solve it kind of using pretty standard methods. And we're going to have a stock market in each country, which is a claim to the GDP here. Now, key here, this is an exchange economy, so how we model output is of course important, and each country produces its own good. And what you see here is basically the good of country I, and it has two components. The blue one, which is a common component, like a level factor. It's non-stationary, that's where you have the growth. And you have the red component here, which is the country specific. So the level factor is basically just moving everything up and down. And this helps us match asset pricing moments, but it doesn't have all that much other roles in this. The X process, these can be correlated, and they are. And we're going to kind of calibrate it to US, where US GDP is more highly correlated with these other countries than what they are in between themselves here. And of course, there's also shocks being propagated through the trade here and relative prices. So in terms of asset markets, it's pretty standard. It's the claim to the GDP in each country, it's the asset market in each country. We have a bond, we can solve for bond prices. And we have a derivative-like market to complete here, basically, this. So pretty standard. So this is where we probably deviate from several models, the preferences, and that's key clearly here. So you're looking at here the representative agent in country J, and it's kind of standard. You have an expectation. You have some over all the goods. This is just the fact that they consume every good that is produced out there. But they don't care about absolute consumption. It's consumption relative to habit level. Here. How do we model the habit level? Well, each country has one for each good. The way we do it is having an aggregate habit level for a good. This kind of captures how close, like the slow-moving part of the good relative to the output process, and then each country put a weight on it, where these weights sum to 1. So this is how we introduce, for instance, consumption home buys in the model. If you have a high phi, it means that you need more consumption to stay above the habit level. So basically, 1 over n, there would be no home buys. But if your phi is higher than that, you attach a higher weight to the habit here. So this differs slightly from how people sometimes model home buys, where it's basically a coefficient in front of the good here. Now, this turns out to lead to not like the consumption of buys leads to portfolio home buys in this model here. So just to kind of give you a quick idea of what we're solving for and what we're taking as given. Well, in this model, it's an exchange economy, so output of each of these goods, that's exogenous. The preferences, of course, we take as given, and there we also how we model the habits. But we solve for then optimal consumption and portfolios, relative prices and exchange rates, and stocks and bond prices here. Okay, so how do we solve it? It's a complete market problem. We use a central planner problem. And it turns out that rather than working with wealth, initial wealth, we're going to work with the Pareto weights. It's nicer here. They show up directly in this formula. They have easy interpretation. Higher Pareto weight, higher initial wealth. Now, given these kind of preferences, they're non-homothetic, so wealthier countries actually act as being more risk tolerant. And this is important here. So US is rich. We're going to assign a high Pareto weight. High Pareto weight, US is more risk tolerant. US more risk tolerant, they're going to lever up, borrow, and invest in stocks here. That's how we're going to get a different NFA dynamics of the US relative to other countries and a different wealth share. So we can solve for the optimal consumption of every agent. So, every country will consume every good, and rather than actually solving for consumption, we can solve for the fraction of the total output they consume. Now, it turns out that this is basically linear in the aggregate surplus consumption ratio. So this tells you something how close you are to the habit now. And a good state is if this is high. A bad state for that good is if this is low. So you can see here, like the sensitivity to this depends on two parameters, basically. It's the Pareto weight and how much weight I attached on that good. So with multiple goods, risk aversion is a bit of a tricky concept in some sense. You can act as being quite risk tolerant towards some goods and some types of shocks, while at the same time act as being quite risk averse towards others. And this kind of multidimensionality is important here because US will on average act as being quite risk tolerant. So that's where the leverage come in because they have a high A. So that kind of pushes the slope to be positive, like pushes it up. But for their own good, this is still very high. So for shocks to the US good, they act as being quite risk averse here. They will have a counter-cyclical consumption share for the US, domestically produced good. Okay, so going to plot a few quantities. Net exports, why is that important? Well, net foreign assets is basically the net present value of the negative of net exports here. So if we flip this and think it kind of will have the same sign, we can guess already that we're going to have a negative cyclical, like a pro-cyclical NFA here. But we see that net export increases in bad states, and basically imports becomes cheaper. That's what's happening here. Now, the dollar, you see this slopes upward. That means that this is the price of the foreign currency. So in bad states, the dollar is strong. What about stocks? Now we're measuring everything in good versus bad times here relative to the US shock. And relative to this shock, we see that the US stocks have lower exposure. This kind of, the exchange rate effect really makes the exposure of the foreign stocks high. So in bad times, you do see all stock markets fall, but the US fall less here. And this is basically what you see here. Here we have the US stock market share, which is just basically a re-expression of what you see in this figure here. And it goes up in bad times, meaning that the US stock market's relative share becomes bigger. The wealth share goes up because most of the wealth is still in the US market. But the net foreign assets, they fall here. So it has different cyclicalities, these two. And that's a key difference from other that have looked at this. So now I go back to this same figure. What's going on here? There's a negative shock to the US, and we're measuring this relative to the US here. What's happening? Well, you see a dollar appreciation. Why? The US good becomes more scarce. That pushes prices up. It's important here with the habits that they amplify this sufficiently. And that's where the deep habits becomes an important factor. Now, you see stock markets fall. We've seen that, and we see the stock market of the US fall less than the rest of the world. So, you know, if they levered and invest in stocks, surely NFA is going to fall here. Not so surprising, they invest more into stocks. But the fact, again, is that due to the higher loading on the US stock market of the US investor, wealth actually falls less in the US than the rest of the world here. Okay, so let me skip this. Okay, so let me move on to the quantitative implications here. So we calibrate this model, and we do a symmetric calibration in terms of GDP, where we assume kind of the same parameter, except one key thing, and that's the shock structure here. Basically, we're going to say that US is more systemic in the sense that their shock actually propagates, and this is the correlation of the other GDPs to the US shock. Now, there's an additional thing here. This is actually stochastic. This is not important for the wealth share dynamics, but it's going to be important for the foreign exchange moments and currency moments, especially reconciling the reversal in the predictability using the interest rate differential. So that's why we need that shock if you want to match that. So these are just the parameters, but if you look at the model, we're kind of, given the symmetry, we can't match a different standard deviation in the rest of the world and the US, but we're kind of in the same ballpark. In our sample, it's relatively short. We use a longer sample, kind of 2% growth. This is not very important for the quantitative implications anyway, in this sense. You see here, what is important is the correlation structure here, where US is more correlated with other countries' GDP than they are between themselves. Okay, so what I'm going to do now is do basically a recession versus normal times in the data and the model. And the way we do it is we calculate the fraction of the time the US is in recession, and we look at the same percentiles, basically, in the model to get a measure of this. And if we look at excess returns, realized excess returns, we see a drop both in the US and the foreign rest of the world markets, but it's much bigger, and this is the effect we've been talking about, that the drop in the US is lower than the rest of the world. And this is due to a strong dollar appreciation down here. I'll get to that. In the model, we also see the same. We can't match the magnitude here. We're a bit off on this. So in terms of exchange rate appreciation, we see that the price of the foreign currency drops in recessions here. Also happen in our model, but the effect is not as strong. And finally, we see a drop in net foreign assets and an increase in the wealth share, as in the data. Again, quantities were off here, so there's more to be done in that sense in terms of matching this. So finally, I'm going to talk a bit about the currency risk premia. And what you see here is a plot where you use the interest rate differential to predict the excess returns here on the currencies. And if you think about, like, on these a month, and on the short term here, this is basically like a UIP regression. If UIP holds, it would be 0. Now, if it's above 1, in this case, that means a negative UIP coefficient. And this is typically what you find if you look at averages across countries, a negative UIP coefficient. Now, if you start predicting these currency returns further into the future, using the interest rate differential today, what you're going to see is that it actually goes towards like the UIP, basically, overshoots and then converges back. And this has proven kind of a hard thing to match for frictionless models. Here is our model, the black line. Clearly, we overshoot. It's kind of too big violation of the UIP, but it has the negative slope here. and then it overshoots as in the data and comes back here. The key here is really that there's two factors going on, and it's the habit that's important, that creates the negative UIP. And on top of that is stochastic volatility that governs how bad this is in some sense, how high the risk premium currencies are. So when volatility is high, that's when we're going to see big violations of the UIP here in the model. So these two factors together can create kind of this hump shaped pattern here. Okay, so this is just an expression of the same thing using in a regression form where you use the interest rate differential, but you include the real exchange rate. You can show that basically you need a negative coefficient on the log real exchange rate would imply something like the pattern here. So again, we can replicate this both in the data and the model here with a positive coefficient like the UIP coefficient and a negative on the real exchange rate here. So just to wrap up, we revisit the wealth dynamics in an international setting and focus on times of stress. Of course, we acknowledge the exorbitant privilege and exorbitant duty, but we argue that in times of stress, wealth actually moves from the rest of the world to the US and not the other way around. And we propose a frictionless model that is very tractable, that can reproduce these facts in general equilibrium. So that's it. Thank you very much.